Hi, let's talk about Tilray. It's a company that engaged in research, cultivation, processing, and distribution of medical cannabis. The company went pretty big so far, 3 billion, and FOFA should not consider investment advice. This have been lately been very volatile because of the share price pumped in mid-February. It went highest point $67. Then it drops back to around $20 per share, and I think now it's currently going maybe up once again. Long term this is looking upside. So as you can see, earnings are forecasted to grow over 85%, but Simple Wall Street shows that it's highly volatile, and they had the CEO change and also earnings update that made the price went pretty much up, and currently the market performance shows that 1 year return is 120%, beating the market and the industry, but long-term price volatility considers highest. So yeah, actually valuation side based on Simple Wall Street, it's currently overvalued by 10%, but I think TipRanks has the more accurate forecast and price target than the Simple Wall Street. Actually, TipRanks has $24.24, and that means 24% upside, and also in good scenarios it could go even up to $26.18, and same as Market Watch. So if we see average of the stock price target is almost $23, so there's the upside. And if you can see the SMI 20 and 50 and 200, so it's an average line of those days. So long term I could say this will grow up. And let's look at the fundamentals. So future growth, as I said, over 85%, which is huge growth is forecasted. Also earnings per share growth is forecasted as well to growth. It might become profitable in 2 years, so end of 2023, reaching the EPS of the 0.4. and past performance decreased by 75% historical annual earning growth. So they decreased in earnings, which is not so good. The company is unprofitable, and financial health look that the depth is going down. I think there was an emission because of the, if you see the simple safe dividends, shows that shares outstanding keep increasing. They're putting the stocks outside, and that's for they can prevent the, for example, if interest rates goes up, those companies that have high level of depth, those are like, this is not the situation that you want to have in your business. So they prevent it by putting more cash into the depth. So the depth is going down, the equity is going up. Also the cash level is not covering the depth, but it's close. So there's a 205 million of cash and 300 million of depth. So I think they're going to right direction. So the depth is decreasing, equity level is increasing, same as the cash, and currently debt to equity ratio is 82%. So it's considered as high, but not like deadly or something. They're not paying dividends and insider volumes. So let's have a see. There's an individual that sold over 4 million of shares. So 4 million of the, so 800,000 shares in the price 4 million, and also the ownership breakdown. So general public holding 66%, institutions 18, insiders 15, and public companies 0.07. Top shareholders, actually not so fresh data here. So for example, Heights Capital Management decreased 30%, but last reporting only date 31st of December last year. But there's a fresh data here. For example, there's a individual that have been decreasing by 3.4%, last reporting holding date 17th of April, and this February. So actually on the both sides, so some of the companies have increasing and the other part decrease. So there's pretty much, I see here, 50-50 situation here. And yeah, as I said, the shares outstanding keep increasing, and total sales also. So the best situation on the market is when shares outstanding decreased by it means that the company doing buybacks and total sales increasing. Then the price would probably look going all the time higher and higher. And yeah, investing.com summary of the stock for long-term investors as a buy. Thanks for watching this video. Subscribe to the channel, like the video, and see you in the future one.